Recently, the Chinese government has been driving to bring top-performing companies in line, but is this just a blip in their long-term fortunes and current prices? Is China a buying opportunity, or should you stay away from it? Hi, my name is Kobe. If you're new to my channel, I focus on helping Canadians safely build wealth and pay fewer taxes. In today's video, I'll talk about the factors impacting the Chinese market and our outlook. A couple of decades ago, if somebody told you that China would be the largest economy, you would have had a hard time believing that. With an economy growing at roughly 3 times the rate of a developed country nowadays, it's no longer a matter of if, but when. But the road is never a straight line, and billionaire investor Ray Dalio said it best, not to expect the Chinese state-run capitalism to be exactly like Western capitalism. China has always targeted common prosperity. The government has tried to balance economic growth and economic equality. Recently, the balance has been swinging in favor of economic equality. Stocks in certain industries are tumbling this year following regulatory changes for some of the country's most successful companies. From Alibaba, the Chinese version of Amazon, to ride-hailing firm Didi and private tuition providers. Real estate and healthcare could be next in the firing line. The cost of education, housing, and healthcare, after all, are often taunted as the 3 mountains Chinese people have to climb. If you're confused why China would stumble national success stories with fines and restrictions on investment, it may be President Xi's attempt to limit the power of private companies, or there may be pushing popular policies ahead of election in an attempt to win another term. But what does it all mean for investing in China? This pullback could represent an opportunity to invest in the world's fastest growing major economy at a discount. After all, the China Internet Index has fallen compared to the Nasdaq by almost 60%. Investors are already piling in, with the sector on course for a 3rd straight week of inflows. But for the more cautious money, there are reasons to hold off. While Chinese stocks overall aren't looking as overvalued as they did at the end of last year, they are still very far from distressed levels where true bargains may be found. Sure, the price to earnings for the index has dropped to 15.6 from 18.3 at the end of 2020, but that's still above the average of 12.5 we've seen over the past decade. And the index's price-to-book ratio, a measure of valuation compared with its company's assets rather than their profits, currently stands at 2.1, more than 20% above its 10-year average. And compared to stocks globally, China's market hardly stands out as a supremely cheap, rather more in line with its long-term average. The past few months have served as a reminder that China can be a risky place to invest. So while valuations in Chinese markets are definitely more attractive than they have been, you may feel safer waiting for an even more attractive entry point to present itself. That's it for today's video. I hope you found it valuable, and if you haven't done that already, make sure to hit the like button, and if you want to see more, don't forget to subscribe. If you have any questions or comments, please let me know below. I read and reply to every single one. Thank you very much for watching, and I will see you next time.